Have you ever wondered if artificial intelligence could design your perfect investment portfolio? Well, in today's experiment, I did exactly that. I asked ChatGPT, a super smart language model, to build me a $1 million portfolio for long-term growth. And the results were surprising. Stick around to see the exact asset mix, the historical backtest, and whether AI can actually beat human financial advisors. By the end of this video, you'll have a clear roadmap for how to harness AI in your own investing journey and decide if you trust a robot with your retirement fund. Let's dive in. Underscore 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 underscore. Act 1. Why AI for portfolio building? Narrator, voiceover. Traditional investing advice often comes from advisors who rely on decades of experience, textbooks, and gut instinct. But what if you could tap into billions of data points instantly? That's the promise of AI: ultra-fast pattern recognition, risk analysis, and trend forecasting, all at your fingertips. So why not let AI do the heavy lifting? I wanted to see if ChatGPT could outperform my own instincts and some of the top robo-advisors out there. Here's how I set up the challenge. Act 2. Setting the ground rules. To keep things fair, I laid down 4 simple rules. 1. Starting capital, $1 million. 2. Time horizon, 10 years, a typical long-term growth window. 3. Risk profile, moderate growth with drawdown limit of 20%. 4. Rebalancing, annual rebalancing only, no intraday trading. Then I opened ChatGPT and asked, design a $1 million portfolio for a moderate risk investor seeking long-term growth over 10 years, with annual rebalancing. Allocate into 6 to 8 asset classes, and explain why you chose each. The response? A beautifully structured allocation across stocks, bonds, real estate, and alternative assets. Act 3. The AI's portfolio allocation. ChatGPT's recommended 8-asset portfolio looked like this. Asset class allocation rationale. U.S. large cap stocks 30% core growth engine, low expense ETFs. U.S. small cap stocks 10% higher growth potential, but more volatile. International stocks 15% diversify away from U.S., capture global growth. Emerging markets equity 10% higher risk, reward from developing economies. U.S. investment grade bonds 15% income cushion, lower volatility. Real estate, REITs, 10% inflation hedge, steady dividends. Gold and precious metals 5% crisis hedge, store of value. Cryptocurrency, BTC/ETH, 5% high risk, potential mega returns. Each slice plays a role: stocks for growth, bonds for stability, real estate for income and inflation protection, and a dash of crypto for a moonshot potential. But before we rush to buy Bitcoin, let's see how this basket would have performed historically. Act 4. Backtest methodology. I pulled monthly price data from January 2013 through December 2023 for each of those asset classes. Whenever data for a precise ETF or index wasn't available, I used a close proxy, for example, using Vanguard's total stock market for U.S. large caps. Key points of the backtest. Initial investment, $1 million on January 1, 2013. Rebalancing, once every January 1st, back to target weights. Dividends and interest, reinvested immediately. And then I let it run. Act 5. Performance results. The AI portfolio grew from $1 million to about $2,150,000 over 11 years, an annualized return of 7.2%. Not bad for a moderate risk mix. Best year, 2021, plus 25%, driven by small caps and crypto. Worst year, 2022, minus 8%, due to bond and crypto drawdowns. Max drawdown, 19% in the COVID crash of March 2020, just under our 20% limit. On camera. So, ChatGPT's pick passed the sniff test on volatility, didn't blow up in 2022, and still came out ahead. But is 7.2% enough? Let's compare. Visual, table comparing AI portfolio versus S&P 500 and Classic 60/40. Portfolio annualized return max drawdown risk adjusted, Sharpe. AI 8 assets 7.2%, 19%, 0.58. S&P 500 only 9.5%, 34%, 0.45. 60% stocks / 40% bonds 6.5%, 24%, 0.50. Narrator, on camera. The S&P 500 crushed returns at 9.5% per year, but you'd have lived through a 34% drawdown in 2020. The AI portfolio was smoother and delivered a better risk-adjusted payoff. And it outperformed the classic 60/40 mix by 0.7% annually. Impressive for a chatbot. Act 6, Deep Dive into Asset Contributions. Let's see which slices did the heavy lifting. U.S. Large Cap, 30% contributed 3.2% to annual return. Small Cap, 10% plus 1.1% but big volatility spikes. International, 15% plus 0.8%, lagged US but less correlation. Emerging Markets, 10% plus 0.7%, strong bounce from 2016 lows. Bonds, 15% plus 0.6%, provided ballast during equity downturns. REITs, 10% plus 0.9%, tasty dividends in low-rate environment. Gold, 5% plus 0.4%, shown in 2020 to 2021 sell-offs. Crypto, 5% plus 1.5%, monster returns in 2017 and 2021, but painful crashes. Crypto was the wildcard, only 5% allocation but added 1.5% per year. If you're not comfortable with that roller coaster, you can dial it down. But in a diversified mix, it worked. B-roll, crypto price roller coaster graph. Act 7, Lessons learned in human versus machine. Diversification matters, AI naturally spread risk across uncorrelated assets. 1. Tuning risk profile, you can adjust allocations, e.g., crypto, EM, to suit your comfort level. 2. No free lunch, even AI can't escape market turmoil, it hit a 19% drawdown in 2020. 3. Ease of use, with one prompt, you get a full portfolio, rationale, and rebalance plan. Of course, a human advisor might bring in tax loss harvesting, customized goals, or emotional support when markets crash. AI doesn't do your taxes or your feelings. But as a starting point, it's a powerful tool. Think of ChatGPT as your brainstorming partner, not your financial god. Act 8, How you can do this too. Want to build your AI-powered portfolio? Here's the step-by-step process I used. 1. Define your goals, time horizon, risk tolerance, starting capital. 2. Choose your prompt, be specific, ask for asset classes, weights, rebalance frequency. 3. Gather data, use free sources like Yahoo Finance, ETF providers, or backtest platforms. 4. Backtest and analyze, check historical performance, drawdowns, risk metrics. 5. Adjust and implement, tweak allocations, set up a regular rebalance reminder. 6. Monitor and learn, AI advice evolves, keep refining your prompts as markets. And remember, AI is only as good as the data it trains on. Always vet the recommendations and consider tax implications, fees, and your own life situation. So there you have it, ChatGPT's $1 million portfolio, backtested and stress-tested over 11 years. Results? A solid 7.2% annual return with less heartburn than a plain S&P 500 play. If you found this experiment eye-opening, smash that like button, subscribe, and hit the bell so you never miss our deep dives into AI, finance, and the fusion of both. Drop a comment below. What allocation would you ask ChatGPT for? And if you try this at home, let me know how it turns out. Until next time, this is Fact Fusion, where facts meet fusion, and your financial future gets a high-tech boost. Stay curious, stay diversified, and I'll see you in the next video.